key thing to note is the gold continues to go up over time, especially when you look at 1, 3, 5, 7, 20 years. It's still in a bull market, so I'm not too worried about it. It's more of a technical correction than any worries that I have that people are actually dumping their physical gold stocks.
It's great to have you. And today we're seeing quite volatile gold and silver markets. We're seeing gold back down below 1900. It's kind of on that line right now. And then silver is below $24. Your take on what is pushing the metals down?
Well, I think it's natural after you have what we had recently, gold touching on its all-time high, over $2,000 or within a penny, I think, of its all-time high. It's just a natural consolidated move where people in the derivative markets, take profits on their positions. We have had a lot of selling pressure the last 3 or 4 days, and it's normal in any bull market. The key thing to note is the gold continues to go up over time, especially when you look at 1, 3, 5, 7, 20 years. It's still in a bull market, so I'm not too worried about it. It's more of a technical correction than any worries that I have that people are actually dumping their physical gold stocks.
We're seeing very little selling here at Miles Franklin. A lot of people are buying, especially silver, and we're still seeing the premiums quite high, even as the metals have come down. It's still around $6, $7 over spot for any sovereign minted coins. And for platinum as well, we're seeing the premiums rise as we're seeing a little bit of consolidation in the price as well. So your take on the physical market right now?
So if you just look at the big physical markets, you look at what's available on the NYMEX inventories list for COMEX, you're down to about 85, 87 million ounces of silver. You're down to about 35 million ounces of gold. It sounds like a lot, but those inventories are lower than what we had last year. So there has been metal that has been taken off the exchanges. And if you look at what's available and registered for trading, we're not looking at all-time high. It's not like we're flush with just tons of metals. So I do think that there's been an inventory drawdown in the big derivative markets. Also, there are some additional markets that are opening up around the world where we're going to get, I think, some competing prices for gold and silver, and we can talk about that. But overall, yeah, the retail trade's been very strong. It's masked again by the derivatives trading, which has nothing to do with the physical dynamic of the market or the actual physical demand for gold or silver. And so the derivative market really is just a bet on what the future price will be. People think the gold and silver are going to fall a little bit. So they take those positions in derivative markets, and that's what happens. But I fully expect it to recover. I mean, the geopolitical issues that we've had have not alleviated the problems with the economy, or actually, I think, getting a little bit worse. We can talk about housing starting to show signs of pulling back. So I think the reasons to own gold and silver are still there, and I don't see anything long term that really concerns me.
No, I know I had one client actually tell me he thinks that gold and silver could go to zero, right? We saw that that movement in oil right around the COVID pandemic, the start of that, where we saw it actually go negative for a little while. Do you see that as a possibility with gold and the paper gold and silver prices, as we could see, completely unrealistic prices for them on the downside?
Well, I mean, you could if I don't know why it would happen. I mean, I think there are traders legitimately would always want to go long gold because they make money. But again, the derivative market has nothing really to do with how the world sees gold and silver as a monetary substitute, or basically as money. It's basically just a trade on where people think gold and silver are going to go. If you can rationalize where gold should be $0, where the world no longer needs gold, I could see that price happening. I think it happened in oil. It was just reflexive of what was happening in the supply-demand market, and there needed to be basically a reset on the oil price, and that's what happened to oil. I mean, could it happen to gold and silver? Sure. It doesn't faze me at all. I mean, I honestly wouldn't care if gold went down to zero, and or go negative. None of the dealers are going to sell it. Obviously, the mines can't operate at that price. It wouldn't stay there for any length of time. Nobody's going to sell it to you for that price. Nobody that really understands the value of gold and silver. So yeah, I mean, it could happen. It doesn't concern me at all, though. I've become less and less concerned over the price movements in the derivative markets the longer I've been invested in gold, because I'm in it for the long term. I'm not trading in and out. If you're trading in and out, you have to be very careful, because you're dealing with the sharks, the big banks there, and they usually win. So if you're trying to trade gold, I would just caution people to do so. Be very cautious with that, because the big banks basically have control of those derivative markets.
Now, we have seen many countries acquiring gold, central banks and countries repatriating their gold. And actually, now countries are opening up new exchanges. We're seeing this in France. This kind of competes with the London exchange, the New York exchange, and the Shanghai exchange. Now we have a Paris exchange. If you could share a bit about this.
Yeah, so we did a story on that recently. One of my subscribers sent me a story talking about how France had repatriated the gold from 2013 to 2016. That didn't really make mainstream news at all, and people were focused more on Germany's repatriation and Brazil and didn't really mention France. But for those new to the gold market, France used to be a major trading hub for gold and precious metals, and was for a long, long time. And the government bureaucrats there had publicly in the press expressed support for doing that all over again. So they're rebuilding some of their repositories and adding computer systems so that they can trade gold and I think probably even silver and maybe some other things as well on the open markets and meet the needs of the market. So Paris has emerged as a big gold trading center. Now, it's not going to start off being as big as London or the COMEX, but it is another competitor. And if we add that, Elisha, to what I talked about last year at the Silver Symposium in Idaho, I talked about how JP Morgan is also helping China expand their derivative markets in the Shanghai. And by offering more products, more commodities, and also signing more banks and more financial parties to join that market. So all of a sudden now we're really living in a multipolar world where you can't just look at COMEX and London anymore, can't just look at the US and London. You have to start looking at some of these other markets. And I think it's going to continue. And it's really just a product of the commodities markets decentralizing into regional markets. We've got regional commodity market. I talked about this a year and a half ago at a Money Metals and Mines conference. I predicted we'd have commodity wars. It's exactly what's happening. The commodities markets are breaking up into regional outlets, and that, of course, is going to entail as well gold and silver.
Now, when you say that breaking up into regional markets, can you expand for our viewers what that really means? Is it like there's different prices at different places?
I suspect eventually it will be. I mean, the majority of the trade, the world's going to go where the majority of the trade is. However, with commodities becoming so important and governments basically going into hot conflicts over them, I think they're going to want to price commodities in a way which supports them. If you look at a lot of the commodity producing nations, they really don't make big margins on the commodities they produce. And where the margins come is in the finished product. If you think about an iPhone, for example, the amount of profit you get from an iPhone dwarfs the amount of profit you get from the 31 critical minerals needed to build that iPhone. And so I think a lot of the commodities producing nations are like, wait a minute, we're producing what the world needs. You don't have anything without commodities because you either grow it or you mine it, or you don't have it in this world, that they're wanting to take more control over the exchanges in which the commodities prices are determined. And so I think that that's going to become more prevalent. I think you're going to see more commodities markets emerge, and there's going to be more competition with the Western markets. Now, whether or not this causes in the short term to have different prices printed, I don't think we're quite there yet. I think the French market and the Shanghai need to continue to build their influence, but I think that day is coming, and it's probably not that far away, where you'll have a quote board and you'll have the American price, you'll have the UK price, you'll have the Chinese price, you'll have the French price, and maybe even a Middle Eastern price.
Now, how is this going? It seems like this will introduce maybe a lot of confusion into the market. How do you think this will impact those of us who are just, stacking physical gold? Is it going to be harder to figure out the price, or how do you think that'll impact gold and silver stackers? Yeah,
I think a lot of the dealers are probably, and a lot of the private sellers are going to rely on the Western prices for now because it's what they know. It's a system they know. But all of a sudden, if you see a 20% higher price on an ounce of gold in the Chinese market, you could see a lot of people argue for the fact that, well, but maybe that's more representative of where the price should be. And you're going to see a lot of price arbitrage opportunities. Of course, a lot of the big banks will get involved in this action by doing price arbitrage between markets. And there'll probably be some insurance and collateralization and things like that, financial concepts around that. But I think if you're just wanting to sell and buy your local, you may start arguing for the price that benefits you the most. And I think that is going to cause some chaos in the markets. And I think what it's going to do is loosen the hold of the Western markets, just monopoly on it. And if the Western markets all of a sudden become the exception to the rule in terms of their pricing mechanism and how they do the trade and how the metal moves about, then I could you could see pressure of people moving over to these other markets because the international banks, the big wealthy elites, the financial money, the hedge funds, they can trade anywhere. They don't need to do it through the COMEX or the UK. They can do it, if they have offices, in China or in France and Europe, which I'm sure they do. So you could start to see the players shift about in terms of where, which derivative market is becoming the dominant one, and it'll be interesting to see how the big players in the market play those price differences as well.
Now, I think the biggest question here then is how long does the paper system last? Because it seems like we are seeing cracks in the system. We've talked about this before. But what is going to actually break the paper system in your view, and bring us to a system that might be based more on the physical metal itself?
Well, I think to actually break the paper system, all of the participating parties would have to recognize the fact that there are supply shortages, a lot of these commodities, that the current system does not serve the need of regulating supply and demand, which it doesn't. That's the main part about the derivative markets. The signals about supply and demand are covered up by those markets. And so the supply demand dynamics have broken themselves. And so we're starting to see supply chain shortages of things that we need. And we pulled things out of the ground cheaper probably than we should have because of some of the price suppression in a lot of the commodities complex. Because if you can throw a bunch of paper on it, you can name your price. Well, naturally, industry is going to gravitate towards wanting cheaper products so they can produce more, so they can get more sales. So the business cycle and the businesses and the corporates have wanted cheaper commodities for the longest time. Well, we're getting to a point at which you can't get commodities out of the ground for some of the prices of trading on these markets. So that's where you're going to have, the market start to come under pressure and people say, well, I can't operate under the prices you've got on COMEX. I'm going to go over to Shanghai. They've got better prices. And I think what you're going to see at the same time is people moving over to other exchanges that more reflect reality. And I think you're going to see a rise in the prices. And I think you'll see a de-emphasizing of some of the traditional Western markets as being the dominant ones. And you may start seeing other prices quoted in the newspaper ahead of what you typically see quoted. And I think that in itself is sort of a breaking of that system. I don't know that we'll ever get away from a derivative system on top of commodities. I think the financialization of the commodity sector is here to stay, but I do think it's going to change.